Welcome everyone to the Watchlist, a webinar series for ASX listed companies to pitch to real investors and be added to their watch lists. Our job is to showcase companies that are on your watch list or give you ideas of companies you might want to put on your watch list. We know being on your watch list is a big deal. Today, we're taking a slightly different approach to this. We're going to focus on a sector in the news and introduce a selection of ASX listed companies in that sector we think you should be looking at. In addition to company presentations, we've also found a genuine superstar fund manager to give his views on the sector and the opportunity presented, to give you those money can't buy insights. Remember, the webinar is interactive. We want you to ask questions of the presenters. So while they're presenting, think up some questions and submit them using the Q&A button on the bottom of your screen. Today, we're talking about uranium, which in recent days has seen its price break above the US $100 mark for the first time since 2007, which has clearly shone a light on ASX-listed companies operating in the space. Shortly, I'll introduce the presenting companies: Lotus Resources, ASX LOT, Toro Energy, ASX code TOE, and Whitecliff Minerals, ASX code WCN. But before I do, I would like to introduce respected uranium fund manager Guy Keller, portfolio manager of the Tribeca Nuclear Energy Opportunities Fund, to provide a keynote presentation and his insights as to why the uranium price is rising and what it means for the sector and the various companies developing projects. Guy, over to you.
As well. Thanks, David. Thanks for having me, and Happy New Year to everybody tuned in to the live cast and watching later. As David said, my name's Guy Keller. I run Tribeca's Nuclear Energy Opportunity Fund and part of a global natural resources platform here out of Australia. I'm pretty much the only dedicated uranium fund manager in Australia and one of only a small handful of dedicated uranium fund managers in the world. We've been running this fund for just over 6 years now. We've got a solid track record of outperformance. As at December, actually December numbers not out yet. As at September, we've returned 565% net of fees since inception, and I expect that momentum to continue with the moves we've had here in January. So as David said, just in just over 4 weeks, whilst we're all enjoying the festive spirit and eating too much ham and turkey and drinking too much beer and wine, the uranium price has surged over 25%. We're sitting at $105 US per pound, and the spot price now, a price we haven't seen since before the GFC. The most important thing, I've received a lot of questions as people are coming back from holidays as to, is it sustainable? Why is this happening? Is it real? Is it financial speculation? And the simple answer to that is the spot market is a very small part of the actual pricing mechanism for the nuclear sector. Remember, uranium is 2 years from mine mouth to reactor core. It goes through a bunch of different processes through the fuel cycle, and that's where the real activity for the sector, the real consumers of uranium as a product to produce zero carbon electricity, baseload electricity, comes from. I can't participate in that as a financial hedge fund, and most people can't. So when you look at this $104 price, look at what the curve's doing. The curve on uranium, December 25 is pricing in about $120, December 26, 125, and out at 27, 133. So it's not just a front-end response here. When we look at the UF6 price, which is the price of uranium after it's converted, it's at $335. The SWU price is $160. Conversion cost is $56. Now, a lot of this doesn't need to be explained, but it's all at all-time highs, and that's the real part of the sector responding here. We've had a lot of questions as well as the equity and why the equity is not responding as aggressively as the spot. And it is a rubber band effect. I mean, as I said, the timing of the move over Christmas, a lot of equity investors were not really tuned in, but we're starting to see it now, and you've seen some good moves in the equities in January. If I may, I just want to touch very quickly on lithium as a comparison, because I get a lot of questions here on uranium. What's going to drive this higher from here? And I had it at $80. What's going to drive it to 100? I had it at $60. What's going to drive it to 80? And the question, I think, is the wrong question. The question you have to ask yourself is, what's going to stop the price going up? Because you've got a supply deficit. There's a primary mine supply deficit that we've had for over a decade. You've got inelastic demand, being utilities and governments pushing that demand. So the demand is long-term. It's baseload electricity, so it doesn't really fluctuate. And in recent years, because of energy crises and supply disruptions and decarbonisation, you've seen a lot of that demand that was going to come off is now back to where it should be, because you're seeing governments, not commercial decisions, governments forcing reactors to stay open longer, pushing through life extensions on those reactors. When a lot of these things were built, they were 40 years just because they didn't know 40 years ago how long they would last. We're now getting 60 or 80 years. And so a lot of that natural decay that you were seeing in demand is staying around. Plus, we're in the middle of the biggest reactor build program we've seen in decades, 60-odd reactors being built. And to put that into perspective, the only supply response of note in new projects is NextGen's Arrow, 22 to 24 million pounds. That single mine goes nowhere near to fulfilling the requirements of the reactors under construction. So we don't have a wall of supply. We look back, people want to look back at last cycle and say, what solved last cycle? The only thing that solved last cycle was demand created because of the GFC. Fast forward now, we've got decarbonisation, energy security, government policy. Supply has to respond, but there is no wall of supply. You're going to hear from a few companies here at various stages that are ASX operation, and there's a handful of companies that are coming into production already. But again, remember, we're in a decade of primary mine supply deficit. We haven't been mining enough uranium to fulfill what the current fleet is doing, and that current fleet is staying on longer. And that's the quick comparison I want to make to lithium. We saw the spodumene price rally from 2020 lows to around $6,000. And some of that equity, the ASX listed Core Lithium, for example, which has been in the headlines now at the other end of the cycle, that rallied 13,000%. Pilbara Minerals, PLS, rallied 4,000% on that lithium rally. Remember, lithium supply is responding now to future demand, i.e. the demand hasn't been built. And here we are with uranium at $100 coming from a low of sub $20 7 years ago. And people are saying, have we done enough? And the answer to that I continue to go back to is no, we haven't, because we're unable to fulfill the current demand, let alone the future demand. So please don't think I'm professing that we're going to have some of those 13,000% returns, and this is not investment advice at all. But the point I'm making is the market was happy to accept an extraordinary move higher in the lithium sector when demand was not certain. And yet here we are questioning a sector where demand is very well known over the next 10 or 15 years. And even if we don't build another new reactor, apart from the 60 being built, we still don't have enough supply on the cards to fulfill that. And so I honestly believe, with the way that the utilities operate, we are at the beginning of what will be a multi-year contracting cycle. Utilities, it's not like coal or gas, where the coal that's pulled, dug out of a mine and put on a ship, it's put to the power plant and it's shoveled into a furnace and burnt. And so it's a very front-loaded spot almost reaction. Utilities are looking 2025, 2026 is tomorrow for them. And as I said, when we look at what they need in the next 10 years, there's a handful of developers that will be able to supply by 2026, 2027. And there's not a lot after that. So, I think this is going to continue. We had Cameco out on some briefings. So Cameco is the largest listed uranium producer out of Canada, and they normally fairly conservative. They're the most bullish I've ever heard them. They are sitting there saying they've never seen a contracting cycle start at such high price levels and with such an uncertainty of supply response. The World Nuclear Association put out a chart, and I apologise, I don't have any slides today. I figured we had 10 minutes, and plus the markets move so fast, I haven't had a chance to update them all since returning from holidays. But the World Nuclear Association puts out their supply demand, and their most recent one last year, on their lowest demand scenario. So lowest demand. So that means that a lot of things that we think are going to happen don't end up happening. It requires the WNA's known universe of not only current mines and under development mines, but planned and prospective mines, and it just meets the lowest demand requirement. Now, the WNA bases all of their predictions off their reference demand scenario. So when asked what's that little gap between what they know is going to come or what they think is going to come, they call it unspecified supply. In other words, the World Nuclear Association doesn't know where that uranium is coming from and how it's going to come to market. And let me just finish. I think we're coming a little close here to the 10 minutes. Let me just finish on one point. It's hard to bring any commodity mine into production. It's even harder to bring a uranium mine into production because of the extra things around uranium, the stigma around uranium. Price is not just the only thing that we're required to get these development assets into production. There's permitting, there's jurisdiction, there's access to capital, there's access to experienced teams. When was the last team that built a uranium mine? It was more than 8-10 years ago. And there's also the exposure to financing for debt project finance. When was the last project finance of a uranium project? So, there's a lot of things that still need to happen. And just because we're at $100 in the spot doesn't mean that there's going to be a wall of supply. We will see 2024 a year ahead of more consolidation, more M&A, and I think there will be a select number of close to production companies that are able to make a final investment decision and then embark on the journey of the rubber hitting the road and hopefully being able to deliver their first drums of yellow cake in the foreseeable future. So 10 minutes is what I had. I think I'll leave it there and open up. Thanks very much for having me.
Thanks, Guy. A great presentation. And for those, as you said, you've been in the industry a long time, you've followed it for a long time, and are probably one of the preeminent fund managers in this space, certainly in Australia, if not through the Asia Pac and global regions. You've followed it closely and you've got some great insights, and we will actually welcome you back. We will be doing something a little bit different today. We are going to welcome you back with the other presenters at the completion of the 3 company presentations, so we can have a much deeper look at the macro environment, where it's come from, where it's going to, and how big the opportunity is. So, Guy, thanks for your presentation, and we will be welcoming you back later on in the webinar.
Okay, thanks, David.
As I said, at the completion of the presentations, Guy and the presenters will participate in a panel session looking at the macro fundamentals of the uranium sector, so stay tuned for that. I'd now like to introduce the first of our company presenters, Keith Bowers, Managing Director of Lotus Resources, ASX code LOT. Keith, over to you.
Thank you very much, David. It's great to be here and talking about our projects as well. So maybe just before I get into the main presentation, I always like to show this as a starting slide in my presentation deck, that there is a picture of the Keynote uranium asset. So Lotus as a company owns 2 uranium projects, the Keynote project, which is located in Malawi, and our second project, which we just completed the acquisition of in November of last year, is the Letlhakane project located in Botswana. But that's Keynote for you there. That's a photo that was taken of the site a few years ago. clearly shows to everyone, I believe, that all the infrastructure required to be able to start Kayelekera is in place, and therefore the capital and the time requirements for us to bring this asset back online are relatively short. Next slide, please. Obviously, won't spend a lot of time on this. This is just regarding our disclaimers and forward-looking statements. This is available on our website for people that would like to see it. So just from a corporate perspective, where is the company at the moment? Share price as of yesterday was around 33.5 cents. That's Australian cents, giving us a market cap of around $580 million. We have zero debt at this stage. As of the September quarter, we had approximately $15.9 million in the treasury, and that money is more than sufficient to see us through the work program I'm about to talk about. Well covered from a number of brokers at this stage as well. And if you just have a look at the pie chart there on the left-hand side there, you'll see a breakdown of the registry. Obviously, very significant ownership from our management team. We've been involved in the project since day one. A lot of retail in there, especially from the Australian side, but we're actually building up our global retail presence as well. ETFs, both the Global X and the Sprott ETF, are heavy investors in Lotus, and we're expecting to see a re-rating from them as well in the next couple of weeks, which we think will be very, very positive for us. Institutions are also starting to take a significant portion in our register moving forward as well. Next slide, please. So what is Lotus about? Well, Lotus is a company that is obviously focused on uranium production. We have the two assets that we are looking to bring back into production. Kayelekera is a low-cost, short-term project that's ready to go into production. Letlhakane is a much bigger project, has around 190 million pounds of uranium in its resources. We see this as being the long-term growth strategy for Lotus moving forward. We know that Kayelekera has got about a 10-year life of mine based on the feasibility study that we put out in August of 2022. However, there is still some exploration upside associated with that, and we could see that life of mine being extended or alternatively the production being increased as well. But really the way we see the two companies or two projects working together is Kayelekera comes online, generates significant amounts of revenue based on the current spot price we're seeing out there at the moment. And the profits generated from Kayelekera would then be used to develop the Letlhakane project, which would come online some years after Kayelekera has started. As Guy has pointed out, and I'll talk a little bit about as well in the slides, very, very strong fundamentals at the moment. I mean, we're talking about the strongest uranium market in more than 15 years. I'm just looking at that price now. The slide's a little bit old. It's $105.50, I believe, today, looking at that price. Highest it's been since 2007. So very, very strong demand and a really issues with supply at the moment moving forward. Proven management team within Lotus, a lot of African experience, a lot of project development experience, a lot of operation and execution experience within the team as well. So we're very, very confident about bringing these projects online at the right time. Next slide, please. So what are the two projects we've got? So as I mentioned, Kayelekera in Malawi, existing plant and infrastructure is all in very good condition. We require about $88 million, that's US million dollars, required to be able to restart this asset. About a 15-month time frame as well required to refurbish this asset. The asset operated previously, so it's a past producer, operated between 2009 and 2014, produced about 11 million pounds of uranium during that period, and was shut down in 2014 effectively due to economic reasons. As Guy has hinted at, post the GFC and post Fukushima in 2011, the uranium price crashes, spot prices down into the low 20s. Kayelekera's operating costs were in the mid-30s. At that point in time, the project was no longer economic, and they put it into care and maintenance to effectively preserve the ore reserves. The project itself has a mining license and all the environmental permits in place. So again, this helps us ensure a short and sharp refurbishment and startup period associated with it as well. We can also access skilled local workforce. A lot of the previous operators from Kayelekera are still in the area, still looking for jobs, looking to come back and restart this mine up with us. Letlhakane, as I mentioned, much bigger project, resource of around 190 million pounds of uranium. That's a very, very large resource. The project itself has its mining license in place. There is a historical feasibility study that was done back in 2016. that looked at around 2.4 million pounds per annum of production for about 18 years. We have a slightly different way of looking at that project, and I'll talk about that in a little bit when I talk about the future work programs. Also important to note, the Letlhakane project is located next to some really good infrastructure, right next to a sealed road, right next to a railway line, rail siding within the mining lease boundary. Substation exists within the mining lease boundary. Bore field for getting water also very, very close to where the mine is as well. So the project has got some really good infrastructure, which of course helps us in terms of not only developing the project, but also reducing the capital as we go about doing that as well. Next slide, please. So Guy's touched on this a little bit. And this is some of the numbers that he was talking about, or the graphs on the right-hand side over there. So again, this comes out of WNA. This is their September report. And I think what's interesting us from a producer side is really the graph on the bottom. So we start off looking at the top graph there. What is the power generation forecast from the WNA in their reference case? So this is not their low case, it's their reference case. It's not even their high case. Today, or in 2022, power consumption or power generation was around 366 gigawatt equivalent. Their forecast is for that to increase by about 3.6% per annum up until 2040, where we would see something in the order of 680 gigawatts of electricity generated during that period from the nuclear power stations. As I said, what's interesting for us is, well, where's the uranium going to come from to be able to feed those reactors? In 2022, reactor demand was around 169 million pounds of uranium, yet existing mine supply was only 130 million pounds. That gap was filled by material coming in from secondary sources, and secondary sources are predominantly inventory, but also underfeeding in the conversion process. But if we look forward into 2030 and specifically into 2040, the existing mine supply, so this is without any new mines coming on, this is the existing mine supply. In 2040, the reactor demand sits at around 335 million pounds per annum. And again, I'm talking about the reference case here, not even the high case. So in the reference case, 335 million pounds of uranium will be required by the reactors to be able to deliver that 680 gigawatts of electricity. Yet the existing mines today in 2040 will only be producing 65 million pounds of uranium. There is a huge amount of room for a large number of uranium mines to come online, and these mines have to come online to be able to deliver the uranium required by the reactors. And the only way that a large number of these mines can come online is if there's a continuing increase within the uranium price moving forward. Next slide, please. Just quickly touching on how we see the two projects moving forward. So as I discussed in one of my previous slides there, Keynote is our first project that we want to bring online. The bottom graph there, the blue bars, show the production profile coming out of our feasibility study that we put out in August of 2022. As you can see there, a 10-year life of mine, very strong production potential in the first 7 years. That production potential drops off as we start to feed material from the stockpiles that have been produced as we're mining from the pit. But that's the opportunity where we see Letlhakane coming in. And in fact, based on the recent work that we've done, we could see Letlhakane coming in even earlier. So that green box there represents the potential for Letlhakane. And what we're trying to demonstrate to the market here is that Lotus as a company will be in a position to be able to deliver uranium as a minimum of about 2.5 million pounds per annum, up to as much as maybe 4.5 or 5 million pounds per annum of uranium for the next 20 to 25 years. And that's the story that the utilities really, really like when we talk to them. So that really puts us in a strong position when we start to talk about offtake agreements with the various utilities moving forward. Next slide, please. So in terms of our value proposition, well, where do we compare against our peers? We've grouped our peers into two different groups over here, restarting mines such as Boss and Paladin with their projects in Namibia and in South Australia, of course, Peninsula as well, with their project that they're starting up in Wyoming as well. The average weighted valuation, if you talk about it, dollars per pound in the ground, for those companies sits at around $8.50. If you look at companies that are developing greenfield projects, you talk about the DPLOs, the Bannermans, the Aura Energies, the average price, or in terms of dollars per pound in the ground, sits around $2.10. Lotus, which has a combination of a restarting mine plus a new development site as well, based on its current valuation, is sitting around $2.10. We believe there is significant upside for our share price to increase such that we can become competitive with the other companies out there that are restarting assets moving forward. Next slide, please. Just some really basic economics as well I want to show on this slide. So assuming we had, and again, I'm pointing, this slide is probably a week old or something like that, where we had a spot price of around $91 per pound. If you look at our operating costs, Kayelekera operates at around $30 per pound, an additional $8 per pound required to get to our all-in sustaining costs. That means we have a margin of around $53 per pound. On our 2.4 million pound per annum production rate, that equates to approximately $125 million EBITDA. And again, if you assume the $88 million of capex required to restart this asset, that means the project or the company has a payback period of less than 1 year moving forward. Those are really, really strong economics for any project, I believe, out there at the moment. Next slide, please. I just want to quickly touch on what are the next steps with the various projects. So as I've mentioned, Kayelekera, we want to bring Kayelekera online as soon as possible. We're looking at some financing opportunities, specifically looking to appoint some debt advisors. We're also having some conversations about potential equity raises at some point in the future as well. Uranium offtake, very big focus for us at the moment. Lots and lots of North American and European utilities are approaching us, asking us or expressing an interest in terms of signing some offtake agreements with us. We're busy having a look at a number of options around that as well. The mine development agreement is an important document for us to be able to start the mine up at Kayelekera. We've been busy negotiating with the government of Malawi for that over a period of time. I've made some good progress in the last month or two, and are hopefully going to be able to announce some positive news on that in the next few months. Operational readiness, getting the plant ready to restart. Looking at our feed program there to complete our detailed engineering design. Operational readiness in terms of recruitment, in terms of training potential as well, is also in the radar and things we're starting to have a look at. Next slide, please. What is Lotus focused on from a Letlhakane perspective? So as I mentioned, very, very large resource, 190 million pounds, but grade's probably a little bit low. 320 ppm is the average grade of that resource. But we know from the due diligence work that we did, there are some higher grade pods within that deposit, and we'll be looking at redoing that resource model to try and target these higher grade pods. We also know there's a potential there to do some beneficiation test work. We were very, very successful in Kayelekera at using ore sorting to increase the average grade of our feed material. Can we use that same technology at Letlhakane, or are there other alternatives such as screening, cycloning, density, or gravity that we could use to try and increase that grade as well? So a combination of the upgrade to the resource model by focusing on the higher grade materials and also the beneficiation program, we're hoping will give us a much higher grade, feed grade to a potential plant that we could then have a look at and go back and have a look at that flow sheet, see whether we couldn't duplicate something like the Kayelekera circuit there as well. So that's what the focus is at the moment. In the future, we are looking at doing an infill drill program. It's important for us to be able to convert the inferred material at Letlhakane into measured and indicated, so we can wrap an economic study around it. We're also proposing putting out a scoping study or a preliminary economic assessment on Letlhakane by the end of this year, really to demonstrate to the market how we see this project being developed. Next slide, please. That's the end of the slides, David. So thank you very much. Happy to take any questions.
Thanks, Keith. A great presentation. And it's probably going to be a question you get asked often, and a question I ask Guy all the time. How hard is it to stay the course when you're picking a project up at a time when the market clearly isn't loving the sector, but you've taken a view and taken a really calculated view on where you think things are going to go, but the equity markets probably weren't supporting you. No one was supporting you. You just had to back yourself and your management team in.
Yeah, so we picked up Kayelekera, Lotus as a company picked up Kayelekera in sort of March of 2020. So I think even at that point in time when we were doing the discussions with Paladin for the acquisition of Kayelekera, we were very, very confident on the uranium market moving forward. And there was certainly a number of investors behind us and groups behind us that had the same sort of attitude and participated in that initial raise and also participated in subsequent raises that has allowed us to keep our dollars topped up in the treasury and allow us to do the program. So we've been very, very focused in terms of delivering a feasibility study that incorporates what we think were the optimization opportunities around Kayelekera, and being able to develop that and let the market develop itself. We knew it was coming. We just didn't know the exact timing of it. And I think from a timing perspective, it's actually been really good for us. We were able to pick up ACAP's assets last year. I think that was an absolute superb timing to be able to pick those up just prior to the market really ramping up on the back of the increases of the spot price.
And just touching from an in-country point of view, how keen do you think in-country there is, or what level of support do you think and a keenness in countries is there to get this project up and running and seeing the benefits flowing back to the country and the local communities?
There is a very, very strong motivation, both from the local communities, but also from the government to get this project up and running as soon as possible. People who know Malawi will recognize it as unfortunately, a very poor country, struggles with foreign currency, is sitting in a very high inflation environment at the moment. They need revenue streams. They need income to be able to develop their economies. And the government stated about a year and a half ago or so that they had identified 3 different areas that they believed could be used to improve the economy. The one was agriculture, and Malawi's always had a very strong agricultural base, but unfortunately was very much focused on tobacco previously. They're shifting that across to more suitable crops at the moment that they believe they can sell internationally. They're looking at tourism. Malawi's got a really high potential from tourism, with Lake Malawi there and a number of really good game parks available for tourism. But really the area that they've identified as being the main driver for their economy going forward is the mining industry. They recognize the mining industry is what could potentially add significant amounts of value to the country moving forward. And not only have you got Lotus and the Keyelekera project, which is probably the first commercial scale project to come back online again, but there are a number of other companies there that have got world-class projects. And I think about Sovereign Metals and their Rutile project. I think about Lindian Resources and their rare earths. I think about Macango and their rare earths project, NGX and graphite. So there is a huge swell in terms of opportunities for the governments and for the communities in Malawi to be able to benefit from the mining industry.
Final question, and as I said, we will get you back on to have a more macro discussion with Guy and your fellow presenters. Mine life, as you said, you're looking at sort of a 10-year at the moment. Do you think there's an opportunity to, once you get in, expand that and grow that out further?
I think there is. I think there's a couple of things that we can do about it. So there's exploration potential. Now, within the mining lease area, there might be a little bit more uranium there, although I think we've covered most of the potential targets in that area pretty well. But what's really exciting for us is what's on our exploration tenements. So we own a further 4 exploration tenements outside of the mining lease. One of them is called Livingstonia, which has a small resource on it. It's about 4.5 million pounds of uranium at the moment. However, the drill program that we did 2 years ago has identified some further high-grade trends that we could follow up to try and grow that resource. And the tenement next to it is called Chilumba, where we did the first drill program ever on that tenement, again, about 2 years ago. We've hit uranium mineralization there. We think there's an opportunity to be able to develop that into a resource going forward. So we could certainly look at that as being the future feedstock for the plant. It's not that far away. It's 90 kilometers away from the existing mine. However, the material is very similar to Keyelekera. The opportunity there, I think, is a satellite pit with a small crushing plant. The ore sorting technology that I spoke about for Keyelekera should be applicable to that material. We produce a high-grade concentrate material that we can then truck up to site and put into the Keyelekera processing plant. There is one other growth opportunity as well that we're trying to get our heads around. 2 different material types of Keyelekera. The Arcos unit, which is the sandstone and hosts most of the material. There's also a second material type called mudstone. Mudstone also carries uranium grades over there. We're limited in the current circuit of how much mudstone we can put into the circuit due to physical reasons, including rheology and viscosity. However, at the end of that 10-year life of mine, there is circa 10 million pounds of uranium still left in those mudstones. If we could modify the circuit or put a side leach circuit onto our process to treat that, that's an additional extension to our life of mine just by using that mudstone material.
Thanks, Keith. Great presentation. And as I said, we'll get you back on in a little bit to have a bit more of a conversation at that macro level, but clearly a well-defined plan, a management team ready to kick some goals into 2024 and beyond. Thanks for your time. Excellent.
Thanks very much, David.
I'd now like to introduce Richard Homsany, Executive Chairman of Toro Energy, ASX code TOE. Richard, over to you.
Hi, David. Can you hear me?
Yep, got you loud and clear. Thanks.
Okay, great. So thank you for inviting Toro to present at your webinar today. Have you got the presentation up? Yep, great. So if you could turn the page. So that's our disclaimer. Next page. So this page gives you a great précis of what Toro has in its energy portfolio. We've had the Wiluna uranium project for some time now, which is 62.7 million pounds of U3O8 and 68 million pounds of vanadium pentoxide spread across 3 deposits: Lake Way, Lake Maitland, and Centipede Millipede. All of our ground in Toro was staked or pegged for uranium, but because it's in a prolific gold mining district, in the bearish years for uranium, we explored for minerals other than uranium. And our Dusty Nickel project has come up trumps. We've made 4 ore-grade discoveries in different locations of massive or semi-massive nickel sulfide. Similarly, we have, because it's a mature gold district, we've also got gold potential on the ground that is contiguous to Dusty and even on Dusty itself, which we didn't explore heavily. Once we made an early nickel discovery, we focused on that. We also have a uranium exploration portfolio of 28.2 million pounds across 3 projects in WA, 2 of which, Dawson, Hinkler and now Thanna, are proximal to the Wiluna uranium project. And we also have a joint venture interest in Namibia with Deep Yellow and Jogmec. Again, the tenements are in world-class locations near operating mines or about to be operating mines. Next page. So Toro has a market cap of 53 million, which we think is very low, and hopefully you can see that by the end of this presentation. Our board and management are quite experienced in uranium. We've either got over 20 years experience, including myself, or 10 years experience in executive and non-executive responsibilities with uranium. For example, I've had responsibility for Lake Maitland, either executive or non-executive, for almost 20 years. Next page. So all up, we have 90.9 million pounds of uranium, 68 million pounds of vanadium pentoxide. We do have environmental approvals which need to be reinvigorated and amended when the government policy in WA changes. And we are currently undertaking studies into our uranium to optimise Wiluna. Lake Maitland, one of the 3 deposits making up Wiluna, has a joint venture hanging off it with Japanese parties, which include a Tochu and a syndicate of nuclear power facilities. And I'll explain that in a minute. So we conducted a scoping study on Lake Maitland alone. So just Lake Maitland, not any other uranium deposit we owned. And the results were quite stunning, with a NPV of 610 million before tax. And we achieved lower OPEX and CAPEX, which again, I'll explain in a minute. Again, Dusty Nickel project is in close proximity to BHP's Mount Keith and to Bronzewing's mine as well. And we're very lightly explored when it comes to nickel. We've still got a lot of ultramafic rock to test. Next page. I'm not going to labour on the uranium sector overview. I think my predecessors today have done a great job explaining what a buoyant and great market we're in and where we're going in the future with uranium. Clearly, we are on an upward trajectory and it looks like it's a sustainable one. Next page. Next page. So Wiluna. So on the map there, you can see Lake Way and then Millipede Centipede. Together, we consider that one deposit. And to the southeast, you'll see Lake Maitland. So as I said, we're in we're at Wiluna, which is 700 kilometres northeast of Perth. The project itself is near established infrastructure. We've got 62.7 million pounds of resource that make up the production profile, and the vast majority of that, almost 100% of that, is in measured and indicated category. The deposit is shallow. Most of it is 10 metres or less. In some areas, it goes up to 15 metres. And again, Lake Maitland only has a joint venture party where the Japanese interests can acquire 35% of Lake Maitland for $39.6 million US dollars. Next page. So in the bearish years for uranium, we did a lot of research and development work and trialing various different ways of optimizing our project and getting a better flow sheet. At lab scale level, we were quite successful, and we reran a Lake Maitland pit optimization. So Lake Maitland only, because we have Japanese joint venture partners only on that, and because Lake Maitland is clay dominant and most amenable to any optimization through beneficiation. So doing a pit optimization, effectively you see that map or the diagram on the page where previously we were only going to mine the red coloured areas. With the pit optimization, we are now going to mine both the red and the green coloured areas. So essentially the pit rim cutoff grade has lowered. The potential ore has gone up almost 200%. Importantly, uranium production has increased by 7 million pounds. The life of mine's gone up from 10 to 17.5 years, and we can now extract cheaply red flake, vanadium pentoxide red flake, because we are now using an ion exchange. Next page. So that tells you the various increases in Lake Maitland from our own internal work about 10 years ago. There's a transformational effect on Lake Maitland. Next page, please. So we ran a scoping study to take into account the revised processing flow sheet from our years and years of research and development work. And again, because Lake Maitland is clay dominant and most amenable to the beneficiation, we just did a Lake Maitland standalone scoping study, which delivered a 610 million pre-tax NPV, a 2.5-year payback, EBITDA of 1.7 million over the life of the project, and an average EBITDA per annum of 100 million. So every week we potentially will generate $2 million of EBITDA. The capex came in at 270 million Aussie or 189 million US, and that includes 20% contingency and 15% for EPCM. The life of mine C1 cost was an excellent $23 a pound, and the life of mine all-in sustaining cost is a very, very, very good number at $28 US per pound of U3O8. And all of this was done on the basis of a $70 uranium price and a $5.67 vanadium price, both in US, and an Australian exchange rate of 70 cents. Next page. So this was the sensitivity analysis we did. The base case is scenario 1. We are now closer to scenario 2 because of the current exchange rate. And you can see that just on a exchange rate being 65 cents as opposed to 70 cents, which is what our base case was, we've got an extra 70 million in NPV. So one of the work streams that I hope to release shortly is that we will refresh our Lake Maitland only scoping study to update it with more current numbers to see what increase in value we get. And we think, obviously, it'll be an outstanding result. Next page. Again, this is just a summary of all of the excellent and robust financial outcomes of the scoping study. And we will produce 22.8 million pounds of U3O8 out of Lake Maitland only over the life of mine, and 12 million pounds of vanadium pentoxide. So we're averaging 1.3 million pounds of uranium and 0.7 million pounds of vanadium per year. Next page. So I'll gloss over that page, so we'll move to the next one. So because of the clay dominant nature of Lake Maitland, we found that by beneficiation, so screening and cycloning, right, we remove the low-grade coarse and the low-grade fines, and we get a beneficiated product, which is 1/4 of the original size, over 3 times the U3O8 grade, and has a recovery of 84%. We undertook this study over many years. Next page. So the beneficiation step of screening and cycloning, so desliming, that makes your leach feed now, when all of the clays are gone, amenable to filtration. That means we can wash the leach feed and remove the deleterious salts, the gypsum, the celestine, and have a product that, because of the removal of those elements, you use much lower reagents, you use much reduced in size leach tanks, and most importantly, because the chloride's not there, you can go to an ion exchange. Next page. So as a result, this is the flow sheet that we are going to pilot this year. We're very happy with the result. Next page. And because of this beneficiation and filtration step, the removal of the chlorides, the salts, everything becomes lower in size. So from the environmental footprint, it's a much lower environmental footprint. The CapEx has been reduced by about 60 million from our last time we had a look at this for the whole of project. The OpEx is significantly lower. It's a mind-blowingly lower number. And because of the beneficiation and the filtration, we can use ion exchange, which means we can get out the vanadium very easily via so it reports to a separate stream, and now we've got a valuable byproduct. We're not in a rush to sell the vanadium. It doesn't make or break the Lake Maitland project. So we can stockpile it and sell it for when it's a decent price. We assumed in our studies a $5.67 US price, but we think we can realize more for that as we go along. So as I said, everything is smaller. The leach tanks could even fit in your backyard garage, I've been told. So on the uranium front, what we're currently doing is a study to incorporate materials from Lake Way and Centipede Millipede into our Lake Maitland processing operation. So all of Wiluna, we're looking to see how we can mine all of Wiluna, not just one. So again, work is progressing well, as you saw by a release this morning. And we think there's another transformational effect on the value of our project coming with that study. In addition, we're going to rerun Lake Maitland in a Lake Maitland only scenario where we have a joint venture partner at a higher uranium price and more realistic exchange rates and costings, or updated ones. If I could get you to turn to the next page. So Dusty, we've made 4 discoveries of massive or semi-massive nickel sulfide. Some of these discoveries are actually on Lake Maitland. So next page. So there's a diagram for you to see. So next page. You'll see some of the results we're getting, 9 meters at 2% nickel, including 2 meters at 4%. This is all massive or semi-massive. 2 meters at 3.5%. We're getting at dimmer over the page, we're getting 4 meters at 1.16%, 3 meters at 1.4%. So these are all grade discoveries. And because of this potential, we're probably going to look at breaking up the company and demerging the nickel from the uranium. Next page. So again, we also have a very good gold project that we haven't aggressively explored due to the fact that our nickel exploration superseded in priorities, given the early success we had. Next page, please. So what are the opportunities here? Well, with the study we're doing now, the Lake Maitland extension study to include Lakeway and Centipede, we think we're going to get a vastly increased mine life, production and revenue. Like there's 36 million pounds of resource at 200 ppm cutoff in Lakeway and Centipede. And we've only evaluated Lake Maitland standalone. That alone got us 610 million. So the potential to truck materials down and process it at Lake Maitland is something that we are considering right now, and looking to see what sort of number we get and what kind of cost efficiencies we can get. We also have an exploration project in Theseus is the leading one that we could turn our attention to this year and potentially explore. We're also going to do a pilot program to test the beneficiation circuit for all of our uranium deposits in the Wiluna Uranium Project, so Lakeway, Centipede and Millipede. That will, again, give us a great knowledge as to how we can maximise this project and increase it way beyond the 610 million NPV that we got just on the one project alone. So the fact we've only looked at one of three and the other two deposits are very substantial in terms of uranium inventory should give any potential investor and our current shareholders a lot of optimism as to what could be possible for Toro moving forward, and increasing the value of Wiluna. Again, we think it's going to be a much simpler, lower environmental footprint operation that'll please the environmentalists, and we will have less tailings because we're mining more of it. So if you could turn to the next page. The continuing optimization at Wiluna, the pilot plant work, perhaps we do some uranium exploration drilling and some more nickel drilling before we spin these assets out, sets us up very well for at least the next 12 months in terms of news flow which will make a big difference to the value of our project. We obviously need to go back and look at our environmental approvals and see how they need to be amended. One of the potential amendments is relocating the process plant to Lake Maitland, given the more favourable economics. So we've spent the last 8-9 years basically with the sole purpose of improving the value of our Wiluna uranium project, and we look forward to demonstrating that further in the next 12 months. Thank you very much for your time.
Thanks, Richard. A great presentation. As you and I both know, we've both had an association with each other, but also with the Lake Maitland project in particular for some time. Clearly a world-class project, and you've added significant value to it over a long period of time, and a path to further refine and optimize and provide greater financial outputs with that project. Just talk us through the environmental approvals process. Obviously, needs to be refreshed. You talked about moving aspects to Lake Maitland to provide more favourable environmental outcomes. How do those discussions occur with the relevant departments, and how confident are you on those outcomes?
Yeah, so I should say that this project, all of Wiluna, was permitted in 2017. So we're not talking about, when Gough Whitlam was the Prime Minister, these projects were permitted. We're talking as recently as 6-7 years ago that this project was approved by both state and federal government. Obviously, ideology has changed here, but we think that the current conversation around nuclear and the current conversation in WA around burying nuclear waste from the submarines and for medicinal purposes across Australia, WA becoming the backyard, whether it's on Garden Island, whether it's on mainland, is going to turn the attention to why are we not allowing the uranium exploration industry to come online here in Western Australia. The fact that the price is moving up now into triple digits places more pressure on the government, more than just me and my peers here going to the government, and we will go to the government very shortly as an industry, so unified amongst the uranium players here. We think that'll put pressure on the government, because previously they could say no and it would have no practical effect because no one's bringing a mine into production at $40 a pound U3O8. But now that we've got what looks like a sustainable higher price environment for uranium, that is what's going to put pressure on the government to reevaluate why they should just keep saying no. But we will have those discussions, but doing it respectfully, not putting the government in a very awkward position. I think they're already in an awkward position due to the market fundamentals. Yes, so we will approach them as an industry, and the plans are already underway to do that.
Oh, and look, the elephant in the room, if you like, is the re-rating of the company is linked in a lot of respects to that change in view. But as you say, the uranium price and the credibility of the companies to bring a project to market, not just to explore, is something that the market is clearly watching and clearly hoping for a positive outcome. So, Richard, I know you've stayed the course over a long period of time. You've continued to add value to the projects. You've continued to do it in a proactive but respectful way, and I've got no doubt that as the discussions become more strategic and more proactive, there'll be opportunities ahead. So we thank you for your presentation, and as I said, I will bring you back shortly to join a panel with Guy and have a more macro conversation. But thanks for your presentation, and we look forward to following with interest.
Thank you very much.
Last but by no means least, I have Rod McIllree, Executive Chairman of Wycliffe Minerals, ASX code WCN, to present. Rod will talk us through the significant attention-grabbing acquisition announced yesterday, and that clearly caught the market's interest and is continuing to catch the market's interest. And I appreciate the fact that Rod is up at, I think it's 4 a.m. or 5 a.m. by now where you are, so I appreciate you making yourself available, not just for this webinar, but for the hordes of shareholders who've been wanting to hear from you since this announcement was made only yesterday. So thank you for your time, Rod, and look forward to your presentation.
Yeah, thanks, David. Yeah, no, it's 4 a.m., but that's okay. We're always working for the shareholder, we say, don't we? Look, I guess I'll just start with a little bit of an introduction. I don't intend to sort of get into the detail too much with respect to sort of the dynamics behind the company in terms of who's on the board or the capital structure, etc. I just really want to focus on the project metrics of what you referenced in terms of the Eldorado recent acquisition. A little bit of introduction about the company. The Wycliffe opportunity was presented to me by several guys in Perth around about July of last year. We were preparing these projects, and there's 3 of them in total. We'll talk about 2 of them today. We were preparing them for a London IPO. And because of sort of long-standing history and relationships, I'm an old Perth guy. I've lived in London for about 15 years now, but some long-standing relationships back there, and the Wycliffe opportunity just made a lot of sense at the time. I've worked in the uranium sector for many years, from 2004 to 2014. I was the vendor for the Langer Heinrich project for Paladin. way back when, large shareholder, sold too early, as most people probably did. So I sort of have a deep understanding of this sort of project generation and getting these things to the feasibility level study. I think there's sort of that Lassonde curve really is the front end of that, is really the best place for shareholders to sort of, make very good returns. So we sort of started with this vision or strategy, if you like, around about 18 months ago, and it came about as a function of, during the sort of the COVID lockdowns, myself and several colleagues who had worked on a project called Cavanafeld, where we sort of, during that sort of 2005 to 2012 period, we drilled out what became is recognised as the second largest occurrence of uranium on the planet. That was in Greenland on the southern tip. We went on to work with the Danish and Greenlandic governments to overturn their or repeal their 45-year ban on uranium. Subsequently, I note in the last couple of years that's been put back on. It'd be an interesting situation to see what comes from that Greenland Minerals and Energy Transition Metals, as they're now known. But I guess the point with that whole process is that we sort of know what we're doing in terms of project selection and project generation. The announcement the other day, there's a couple of key things, I guess. We'll go to the first slide, if you like. So it's a very large land holding. That's key. It surrounds previous mining centres, the El Dorado, the Contact Lake, Echo Bay, and further to the south, one that we haven't really brought up in terms of investor attention yet is the Toro mine. Two sets of licenses here, one at the state level and one at the federal level. Not a lot of consequence between the two. It's just that old mines tend to be managed by the federal regulator for environmental and sort of remediation purposes. The key message with this project is this is organically grown, and much like several other projects throughout our careers, we have identified these at the grassroots level. For some reason, I'm really not sure why, but this project was just sort of forgotten about in the annals of the mines department in Calgary. And one of my colleagues over there was, during, as I said, during COVID lockdown, just spent a lot of time in the basement reading old paper reports and identified this. So I think that the key with this really is, instead of this being a large vend where, a listed entity may pay anything from sort of, $5 to $55 million for a project of this nature, and how taking into account how advanced it is. We only paid 150,000 Canadian dollar facilitation fee for this consultant to lodge the licenses and make sure all that administrative paperwork is done on the Canadian side. So what that means in the short term is all of that value really is attributed to existing Whitecliff shareholders. There is a sort of a long history here. It started in the 1900s. In the very early 30s, it started to get a little bit of momentum. It produced uranium at El Dorado initially, from the sort of mid 30s through to the sort of 50s. Due to uranium price collapse, the El Dorado mine shut, and then the regional mines kicked in, because what this project, I guess, represents is not just uranium. What we have here is a model that is a sort of an IOC, or an iron oxide copper gold, and that is a similar geological model to Olympic Dam. In fact, this project is recognised by state surveys as holding the highest potential for IOCG mineralisation in all of Canada. Now, that's quite a badge of honour when you take into account what Canada represents as a mining jurisdiction. So these El Dorado, Echo Bay and Contact Lake deposits really are sufficient expressions of sort of a vertical vein fill. High grade tends to be sort of the last gasp of the emplacement mechanism of all these fluids that go through and drop off all this metal, precipitate all this metal into these very reactive volcanic rocks. And so these old historical mines, as you can sort of see there with all the markings, represent sort of the high-grade expression of what is believed to be a much larger bulk tons, probably lower grade ore body at depth. So we're going to be working there in earnest this year. We have an enormous amount of data that has been assimilated over the last sort of 12 months, because one of the things with these types of projects, they take a while to sort of get organised. This hasn't happened in the last 72 hours. This has been months in the making. Large amount of data that needs to be worked through, very high grade expressions here with sort of broader anomalous regions throughout the license area. For those of you that sort of live on the East Coast, 3,300 square kilometres is around about 1/3 the size of the Greater Sydney region. So, it's a substantial land area. Next slide, please. So just a little bit of a photo there of the Radium Point mine processing facility. It was an underground mine. It was discovered, as I said, in sort of the early 1900s. They've done extensive mines here. I wouldn't sort of suggest that these are in any way in good condition. I think that the whole process really needs to sort of start again in terms of an exploration and a geological model evaluation process. There's two ways to sort of approach this. You're sort of looking for these crackle veins, etc., and or you're looking for sort of the bigger targets, the IOCG, which from all interpretations are sort of a long strike and at depth of these things. But if you look at the scale here, that El Dorado long section, you're only talking that main area is only sort of, 600-800 feet along, that encompasses the main shaft and the 4 main veins that were exploited. These veins can be traced for kilometres. So we have an enormous amount of confidence that we're going to be able to extend known mineralisation. As I said, we have databases here of a lot of historical results that just due to their high-grade nature, we weren't necessarily confident reporting these to the stock exchange, because, we've all got too many scars from doing that. But I think one of the things we will be doing is validating these results over the coming season with a view to getting some drill rigs in here ASAP. Next slide, please. So, you can sort of see just from this other picture as well that this is a proper province at one stage. This has the the reputation, or is recognised as being Northwest Territories' first operating large-scale mine. It, over the course of that sort of 40-year period, from the late 30s through to the very early 80s, produced what is a significant amount of metal just out of 3 relatively small mining centres. These numbers, if you add all of that up, that's more than $2 billion US dollars in today's value that was produced during that 40-year period. Now, interestingly, and this is really rare in the terms of the commodities world, or the mining sector in general, the exploration sector, is to be able to walk into a region, a proper region, right? This is Canada, and find a project of this nature without any license on it. It's remarkable. And one of the good things about Canada in this part of the world is that there's a lot of service providers up there. I'm not sure how many of your viewers are familiar with sort of the economic significance or consequence or situation of our Canadian brethren, but they're not in too good a shape, their industry over there, certainly their exploration industry. And so one of the things that I think Australians have done very well is position themselves in terms of the lithium, and now we're going to see other projects come to the fore as, we sort of benefit from, capturing that lithium wave in Australia that has monetised our industry to seek resources and reserves all throughout the world. So we're very excited by this project. It's cost us nothing. So, we're coming from a very low base here, I think, in terms of peer comparisons. You can do your own metrics, but we've got a market capitalisation of 19 million Australian dollars. And that's sort of circa £10 million. And I can tell you that a lot of people here in the UK find that very cheap, relatively great value. And I can sort of see a very strong share price response to the news as it comes out, as we develop this project and make it more appreciated in the wider market. This is something that we're going to be working on heavily leading up into the field season to make sure that the whole world actually understands, that Radium Point's now back online. So next slide, please. With a creaky table here, I apologise about that. Again, this sort of comes into our broader strategy with respect to what it is we were going to be doing, or what we are going to be doing with Whitecliffe. I think one of the things that we took on very early, and it comes as a function of recognising the market dynamics between the spot, the long term, and some of these guys in Canada, I refer to them the smartest guys in the room. They sort of come in and they swipe the spot physical. And what that means is as the price steps out, they're sort of dropping a little bit of supply out for the reactors. The interesting thing here, and everybody's got their view on uranium. I don't intend to spend too much time on it, but this has only just started. One of the things that a reactor has is almost an indifference to the uranium price. It's such a critical input to the overall process, a capital investment of $10 billion versus a price per pound of a couple of hundred. They're just price insensitive, this stuff. I think what has happened over the last several years to several decades is that they've kind of gotten fat on their ability to manage the spot price, to create a situation whereby they use that spot price to mark their long-term offtake prices, where most of the volume happens. Well, that's no longer the case now, because there is actually no physical spot. It's comes at the good graces of some of these ETFs and Sprott Physical and a thundering herd of hedge funds that sit behind them. So I see this, this early price rises. 150 is the next stop for uranium. I'll call that now. And I think we've positioned ourselves beautifully to take advantage of that. The second string to the bow of Whitecliffe really is whilst the uranium is in the power generation, one also needs a foot in the power distribution concept. And one of the leading metals in that is obviously copper. We, again, through pretty solid geological work by the team, some of the guys I work with, they identified this project, and we subsequently took out very large licenses, holdings right up in the Northwest Territories. For those of you that are familiar with this part of the world, but unfamiliar with us as a team and a sort of a experience, we've spent the best part of 20 years, probably even longer now, working in the Arctic. We spent a long time working in Greenland. We have a number of projects over there. We've got joint ventures with large American private equity funds, and we understand the logistics and the climate and what needs to be done. And all of our mistakes, I think it's fair to say, have been made back when we were younger in this part of the world. We have a very clear understanding of what's required to operate here. And I think that during 2024 is really going to be one of these years where we confirm what we have, we expand on what the projects represent and what their potential is. And, as I said, there's a third project hopefully coming in here shortly that probably just as big, if not bigger, than all of these things, that fits into this overall strategy of where the company's going. Next slide. Yeah, look, I mean, I'm not, again, don't want to sort of bore people, because I think, we've come to the sex and violence end of the webinar now, but these geological models are very well understood. They're recognised globally as being very productive for metal production and or emplacement. This is the model for the copper mine deposit. Similar sort of model can be applied for IOCG. You're talking large amounts of fluid in the system, deep plumbing, reactive rocks. It's just what type of metals have been dissolved in the fluids that are travelling through these sort of reactive rocks, etc. But they always tend to be involved, associated with volcanics. As I said, a large amount of fluids. If you can sort of see just over to the left of this visual, those sort of red cracks, to a certain extent, that's what we're looking at in terms of both Copper Mine and the Radium Point, is the sort of surface expression, the blow off of really these last gasp volatiles as sort of all this emplacement takes place. They tend to be very high grade, low tons, but you can sort of get a start on these things. The bigger picture here, though, really is going to be sort of chasing down the plus billion ton resources in terms of the sediment hosted red bed copper, and also these IOCG deposits at Bear Lake. And probably all we need to do on that. Next slide, please. So yeah, look, I mean, this chart, it was kind of pretty groundbreaking when it first came out. I think every investor had an inkling that this is the case just through hard-won experience. But one of the things I've always found as an investor in the commodity space is you've got to be at the start of the curve. You don't want to be at the top of these things where you're sort of moving into what is kind of generally considered a news desert, or just an orphan period, or even certainly, relatively speaking, I mean, starting production's fine if that's your thing. But I've always found the best part of the market returns are always on that discovery phase, reevaluating old assets that you get cheaply and bringing them back to life, so to speak. For example, Langer Heinrich, went to several $1 billion with Johnny Borshoff. Several other projects that we've done over our lives. Greenland Minerals and Energy under my management went to almost $1 billion ASX 200 company until the 14 collapse. And this is where we've positioned Whitecliff to take advantage of these discovery phases that we will be undertaking in 2024. We've got a bright future in front of us. We've got a lot of support out of England that will be brought to bear now that these two assets certainly have sort of been announced. A third one coming. It's pretty well telegraphed over the next couple of months. So yeah, look, I think that sort of covers it all. I don't think there's another slide. Okay. We better talk about our Australian stuff. So when I first joined Whitecliff, they had quite a large portfolio of rare earth, lithium, and gold, and various commodities. It was quite a well curated portfolio. I think one is can be fairly certain that we are going to be moving this set of assets on. Hopefully as an entire portfolio. I think in their current form altogether, they represent enormous value for a potential acquirer. Not too much to talk about there really in the future, apart from we're not going to lose focus on these Australian assets. We really are going to get in and look to focus all our time and energy and resources on these Canadian assets. So Dave, I think that's pretty much it.
Thanks, Rod. First of all, thanks for staying up late or getting up early, whichever way it was. And as you say, we're now, what did you say? We're at the sex and violence end of the presentation. So whatever form that takes, hopefully neither of those will be visible here on the webinar. But a question for you: where I know it's only early days, you've picked up the assets, clearly very excited, as is the market. Where do you turn your attention? What does the work program look like? You may not have articulated that yet to the market, but what does the work program look like, and how will you sort of choose to focus on the two projects moving forward?
Yeah, I guess there's two streams that will be running roughly in parallel. One is the validation of the existing data sets. One of the I wouldn't call it a constraints. One of the the framework for releasing results, whether they be geochemical or drilling results, etc., come with necessary verification processes. And at the moment, because of the historical nature of this project, we're not able to announce any of those results, some of which are quite extraordinary, to be quite honest, just still sticking out of the ground. So I think there's a verification process that shareholders can sort of look forward to as we work through that data set and verify those things, and then make releases on the regional project areas, the anomalies that have been the Gossans, a little bit more information about the mines themselves. But second to that, and probably a little bit more relevant to listeners today, is the actual work on the projects themselves. So we without sort of burning the powder, I guess, we have work programs that have been defined now for Coppermine. Coppermine is the most northern project we own. That will be the initial focus. We will then withdraw those assets as the season closes over there, and we will come down to Radium Point, complete the work programs there. It'll be a combination of airborne. We're working with quite a number of Canadian consultants. Interestingly, Dave, one of the things in Canada, and I touched on this before, just because of the economic situation or whatever it is in Canada, there's a lot of service providers, and you can get some really good rates for activities through all these sort of third person or third party contractors, whether they geophysical, geochemical, drilling, etc. There are some other groups in this broader region, American West Metals, I think they're called. They're up to a little bit to the northeast. We're sort of looking to replicate their success in terms of contractor selection and piggybacking off their guys who are already in the area. So just cutting down that mobilisation, demobilisation, reducing the cost of the overall program is really core to the approach there. But yeah, a lot of results. I mean, really, the key value, if I can leave listening interested parties with a bit of a hook here, the key metric here is to get these projects back on the map, because they're in some cases, the copper mine hundreds of years old, sort of lost in the annals of time. Radium Point, lost for the last 40 years. Get these projects back on the table, get them in the peer tables, get people understanding actually the true scale of these things. And, that's when you're going to get your real move in the share price.
Final question before I welcome everyone to the panel. You are familiar with permitting challenges, safe to say.
Mm-hmm.
How does this jurisdiction compare to some of those jurisdictions you've worked in previously where you have had permitting success? How does this jurisdiction compare?
Well, I mean, let's compare it to Australia, which is a jurisdiction everyone understands. I think Canada, I'm as nationalistic as the next guy, but let's be honest, it's getting difficult in Australia to get things done, whether it's because of a cost barrier, a permit barrier, a NIMBY barrier, an Indigenous barrier. The barriers are just, appear from my perspective to be just becoming endless. So this really, again, comes back to, this is a very well thought out strategy, Dave. This is something that we've looked at and compared in terms of permitting and what's required here. These areas are very pro-mining. They've been pro-mining for a long time. Yes, there's obviously environmental, but there's environmental considerations in every place. What you have here, I think, is this is based in North America, and this is primarily where the main driver of, a lot of this North American focus is going to be. There's a very parochial colour coming to the US. They need to secure their own supply lines. They've recognised that, some of these lesser developed countries are not as reliable as they once were for whatever reason. And there's an enormous amount of effort and time and investment, that's going into working up internal supply lines. And one of the things that we hope to be is really at the front of that queue in terms of, potentially state subsidies, some investment, getting assistance with getting what was, Canada's largest uranium mine. Just think about that for a second. Canada's largest uranium mine, getting that back going again. So I don't think the permitting here is going to be any different. You know, we've started the engagement process with the Indigenous, the First Nations. The Mines Department are very well known to us because we've sort of driven them mad over the last 12 months. Yeah, we're in good shape, mate.
Thanks, Rod. A great presentation. As I said, early days, given only just recently announced the transaction, but clearly caught the market's attention. A management team with strong capability and strong track record of delivering results. So one to watch. I will ask you to hang around just for a minute while we bring everyone on for a broad panel session, more on the macro situation in regards to the nuclear position and uranium in particular. I've got a question here for you, Guy. I know you've been sitting patiently waiting and have followed the uranium market for many years, as has a number of our presenters here today. A lot of the presenters here aren't new to uranium. They've been in the sector for a long time. So first one, more at a fund level. What projects are you looking at and why at the moment?
Sorry
to put you on the spot.
Yeah, look, I look at everything. I mean, I'm a global investor, so roughly 65 to 70% of my current portfolio is actually not in ASX listed opportunities. You know, to get that diversification, I do spread it out. So, you know, I've made no secret that I have been fairly heavy in some of the larger, more funded companies, Cameco, Boss, Paladin in 2023. It was something that we identified as a trend across all resource equities, that investors were wanting to be in larger, more liquid opportunities. And that was no different in uranium. I stayed away a little bit from some of the developers updating numbers last year. That's changing now because the price is moving to a point where they're getting a little bit more interesting in what they're going to be doing in the next few months. And, you know, like I have had a long tail. So, you know, some of my best trades have been some of these last cycle sort of things like Rod was alluding to. The great thing about the uranium sector is there has been a previous cycle of public market activity, and before that there was plenty of mining and exploration done from government levels through the 50s and 60s. So there are a lot of historical gems that are going to pop up from last cycle to be able to play as well. So, you know, the trick is just being, as I said, it's not really probably the answer you wanted, but you have to be broadly across the whole market cap stack and jurisdictional opportunity set.
A question for Richard. How hard is it to hold the line when, and I suppose for all of you, you've either picked up projects or developing projects at a time when the sector was not buoyant, the prices weren't buoyant, the market, you know, you could probably walk down any of the key markets globally and knock on doors and get a lot of rejections. How hard is it to hold the line of where you know and think the market's going to get to and just stay committed and not jump from one thing to another? Richard, I'll start with you.
Yeah, thanks, David. Look, you have to be patient, you have to be thick-skinned, and you have to think of ways to stay alive. Some companies like us were fortunate to have other tenements that were staked for uranium, that we were able to attract investor money on other minerals, namely nickel and gold. But because the number of uranium names in Australia with developed assets or, you know, advanced assets like Toro are few and far between, I think you can keep your head above water, or at least your nose and mouth above water, because you've got such an advanced asset. You've got JORC pounds, you've got measured and indicated inventory. That's what's helped us keep going. And because, look, I got involved in uranium with ERA. I used to work for North, the major shareholder of ERA, who had a mine up at Ranger. And when I worked for the group, uranium was $9 a pound. So and they were producing and selling. So when uranium hit $20 a pound, you always thought, well, at least it's twice as much as, the absolute floor, which I experienced in the 90s, late 90s. But yes, you have to be resilient. You have to think of ways to keep going. And we're fortunate enough that we got exploration success on nickel. And yeah, we've got to remain patient again to help convince the government that they need to reevaluate their policy on this.
And what about you, Keith, picking up a project that had clearly was well known at the time, a big shot, if you like, of this is where we think things are going to go. So we're going to back ourselves in on picking up a project and then convincing and reassuring, if you like, the government that we're here for the long haul and not just for the short ride. Again, you picked it up as the market was starting to turn, but you still had to have that resolve and then convince others to put their money in the bank when they could have put it into a whole range of other exciting things. How hard was it, and how focused did you have to remain?
I think Rich has made two good comments there. I think patience is probably a really, really important requirement for anyone that was in the industry a few years ago, but also belief as well. I mean, you have to have a strong belief that the market is going to improve, and that's certainly what our team felt. We haven't been in the uranium space for that long, but certainly of all the commodities that we were looking at a few years ago, we certainly felt uranium was the one that had the greatest opportunity for improvement going forward. I think also you have to have a really strong understanding of what you have. I mean, Keynote, I think, as a project within the industry, was recognized to have some problems associated with it, some of them technical, some of them cost problems associated with it. And really, we spent a long time looking at that project, understanding what the issues were, trying to put together a strategy that we believed could overcome those issues. And that was the work that we did for the first year or two once we got hold of the project, was actually going through and doing those technical programs, looking at things like acid, looking at things like ore sorting, even simple things like connecting a plant to a national grid. I mean, that single activity at Keynote has reduced our operating costs by $6 or $7 per pound. It has a huge impact on it. But how do you go about and do that kind of stuff is also important. So you need to understand exactly what you've got. You need to understand where you think you're going to get there and plot out a solid plan to get there and communicate that to your shareholders, communicate that to the investors, and get them to buy into the story with you as well.
And Guy, I'm going to put you on the spot and sort of, I think, fairly pump you up. And every time you and I have this conversation, you hold your hand to your face. Genuinely one of the superstars in the industry when it comes to funds and understanding the nuclear and uranium space. How hard was it, like you said, going back, 10 years ago to convince the guys at Tribeca, I want to set up a nuclear energy opportunities fund when the whole market was in the doldrums, there was no positivity, to even launch the fund, you needed to go and convince a whole lot of instos and others to roll into it. So talk us through that early stage of, as the guys said, they had to have patience and they needed to have focus and resilience and all those things. But you were walking around asking for big amounts of cash to fund some ideas that potentially were going to be 5-10 years in the making.
Yeah, it was. I was lucky. I had a day job working for the Global Natural Resources Fund, I tell you. So that kept the bills being paid. But yeah, we were sort of lucky because we identified the opportunity in the Global Natural Resources platform and started actually accumulating some positions in that fund. And that was around the time that Yellowcake listed on the AIM as well. And to get, significant enough positions, we ended up being substantial shareholders in a lot of things. So I think we were 9% of Yellowcake on IPO. Keith was a boss back then, and we were 6 or 7% of that, and just everything we touched. So the decision to launch a smaller sort of satellite fund was sort of born out of, we wanted the exposure, and it was a really small investment opportunity. But yeah, when we launched that, it was basically a bunch of partners here at Tribeca who who seeded that fund with a few, rusted on uranium bulls that were investors in our global natural resources platform. And that was sort of it for about the first 18 months. In fact, I remember having a beer with a few other fund managers here in Sydney, and one of them said, "You're going to be the shortest lived fund manager in the history of fund managery," which was interesting because I didn't know fund managery was a term. Fast forward 4 years later, he's on site at the Boston Honeymoon in South Australia, wanting to get up to speed on the sector. And I reminded him of that conversation. We had a giggle about it. But yeah, it was the one positive for me was I became pretty popular with all the guys in the uranium sector when we announced that there was somebody who was just going to be focused on uranium as an institutional investor. So I did have a fair amount of a period of time back there in the early days where I was able to pick the brains of the guys here on this podcast and webinar and others globally, and really get into the weeds of the sector and really skill myself up in a short period of time. And it was access that others are now struggling to have because there's a lot more people trying to rush in to get themselves up to speed. So yes, we were early. Yes, it got a bit lonely, but we were sort of fairly convicted that just the sheer fundamental mismatch amongst a political change in sentiment was going to eventually play, and it did. It took longer than we expected, but I don't think it's going away.
Just touching on that, and Richard touched on it a short time ago. You talked about political sentiment and the change in political sentiment, both at a micro level, at a country or even a state, through to a regional level. Are you seeing that change occurring maybe at a faster pace than what everyone is expecting, given the whole clean energy, the energy dynamic conversations that are happening, that states that maybe and countries that maybe were reluctant historically to be in that discussion are now noticing or acknowledging that it's a discussion they need to be well entrenched in?
COP28 was the perfect example of that, and the perfect example that Australia and Australian politicians are asleep at the wheel. Here we are in the UAE, which 15 years ago was just starting to dream about nuclear, and now 25% of their electricity is coming from zero carbon, 24/7 baseload electricity being nuclear. But more importantly, 24 countries agreed on a pledge to triple nuclear capacity by 2050 in order to meet decarbonisation targets. COP 27, 26, 25, 24, you go back, there was, nuclear was just not on the agenda. And suddenly this year, or last year, 2023, front and centre. And we sort of sit here in Australia and forget that there's a whole bunch of countries that are not Australia that are throwing billions of dollars and multi-decade commitments to ensuring a nuclear future, to give them that zero carbon baseload electricity that we have to have if the world is serious about phasing out things like coal and then gas.
Now, I won't ask anyone in this room to comment on that, apart from Guy, because he's allowed to say those things without fear of feedback from the country owners of the respective projects, Richard's in particular. Rod, question for you. You've been involved in uranium for a number of years, particularly at the exploration development end. Just talking back, similar to what Keith and Richard and even Guy were talking about, you go through waves where you knock on a door and all the doors open when you're there talking about lithium 2 years ago or gold 5 years ago or other commodities. How lonely was it walking the streets at various times, knocking on doors about uranium and wanting to tell a uranium story versus, even the last 3 months, knocking on doors saying, hey, we're looking to pick up a uranium project, and even the last 24 hours, the sheer weight of interest that's come through from people wanting to know and hear more or buying shares and supporting the company?
Yeah, I was sort of fortunate, I think, in many respects, Dave. Good luck just as much as good management in terms of having a resource to drill out whilst you're telling that story. The old Kvanefeld project was something that was originally very similar to Radium Point, was defined by the Danish State Nuclear Agency. It was going to be a feed source for what was Denmark's, what at the time was going to be their nuclear industry until that sort of groundswell and 3 Mile Island, et cetera, et cetera. I think it's important that the story that you're telling corresponds to what it is that you're doing, and having that Kvanefeld project, which is, it's a beautiful ore body, this thing, and not to distract attention from the 3 presenters here, I think that at some point in the future, the world's going to wake up and that project will ultimately get permitted, but that's a story for a later stage, is, just to be able to have something that you're drilling out and you're proving up, and that sort of identification discovery phase as a sort of, part of that curve is really the meat of the value chain. And if you can tell a sort of a longer term, this is the direction we're going, this is the commodity, even if the commodity is not moving, or even if it's sort of moving down, that discovery process actually, papers over a lot of issues in terms of price and strategy. And, so I think it comes down to your project selection. There's the three of us here, we've all got good projects. There's a lot of stuff out there, and I think one needs to keep in mind the backdrop of rules and regulations. Now, these things aren't insurmountable, as we proved at the time with the Danish government, but they take time, right? To get an entire country to change one of their most tightly held beliefs, that wasn't easy. And so you got to dedicate time to it. You got to be prepared to dig in. It's trench warfare. You guys down in Western Australia, you've got the same thing with the state government. You can't give an inch. You got to push. You got to push. Every centimetre you can take from them is a centimetre you take for yourself. So, regulatory stuff is the hurdle. We all know that.
Final question, and it is for the group, so I'll let everyone sort of have a think about it as I read it out, and it's a good question. Last time uranium prices were at these healthy levels, around 2007, buyers started to push back on the price. This has partly been answered by the speakers, as we've talked about, but how high can prices run before the generators start to complain about their margins? Given the shortage of supply, are producers better placed to maintain higher prices this time round? Keith, I might start with you. You're probably closer to the restart point, and then if I go Richard, then Rod, and then finish with you, Guy.
I think it's a real interesting question, and it is something that's been posed to us recently with obviously the increase in the spot price. I think I'd go back and reference, I think Richard made a comment on it. He was saying that if you look at the cost structure of a nuclear reactor, how much does the nuclear fuel actually make up in terms of that cost? And it's probably running at maybe 5 or 6% at the moment, compared to, say, if you're using gas or something like that, where the gas price actually makes up about 80% of the cost associated with generating electricity from gas. So from that perspective, the uranium price is not the most significant driver in terms of the cost of nuclear power generation. And if you take that into consideration, I do think there is still an opportunity for a further increase in the uranium price before we start to see some really strong pushback. Whether the governments will get involved in it, I have my doubts about that, to be honest, but it is possible. But I do think there is still a lot of room in that uranium's price before we'd actually start to see any impacts from that side.
And Richard? Oh, we got you on mute, I think.
Sorry, yeah, I would endorse strongly the views of Keith just expounded. The cost of uranium in the fuel cycle is very minor, so it can tolerate more headroom in the current from the current uranium price, and of course having more supply come into the market helps long term for energy security, energy diversity, and and the ability to continue with this clean energy source of nuclear power. An interesting question, I'd put it to Guy. The pounds that the Sprott Uranium Trust are accumulating and other similar smaller funds are accumulating, that's pounds being taken off the market. I'd like to know Guy's view on how those pounds will ever see the light of day generating electricity. Does someone have to take over Sprott or Yellowcake to get their hands on that inventory, or is that inventory just staying locked up away from the market for decades and decades? That's also another contributing factor to the supply squeeze. You don't have the decommissioning of the old weapons from Russia, and now you've got dedicated funds buying physical. So I think there is, the uranium price at these levels is not going to harm the nuclear power companies too much. Of course, there'll be pushback at some point, but don't think we're anywhere near there yet.
Before Guy jumps in, I did note that Rod, in his ultra bullish phase, is predicting 150. So clearly, he doesn't think that the uranium producers and the power companies are going to be too affected by both price increases, but also sustained price increases.
Yeah, look, Dave, I think, you've always got to be sort of cautious about making statements like this time it's different, right? But if you've lived and breathed this for long enough, you know that the last significant rise in the uranium price was due to Paladin having to cover shorts because their production didn't quite work for Langer Heinrich. And that just happened to coincide with, a mini ESG process that the humans were sort of evolving through at the time. And that sort of led to a broader interest in the stock. The price of uranium ran to 160, but the fundamentals weren't there. It was driven by a scramble to cover that short. I think what we have now is something far different. I think that the way that the game was played before is no longer the way the game is going to be played in the future. And that comes as a consequence of these ETFs and securing this spot supply. I think the one thing that, the utilities have no choice. This is a seller's market, and it comes as a function of lack of investment for the last 20 years. A couple of nuclear accidents that are high profile and, unfortunate for the industry, obviously. But this is a supply issue, not a demand issue. These reactors, they don't have a choice. They have to buy this material 4 or 5 years out so that they know they book slots in refiners, those rods get delivered to the reactor. This is a 5-year chain of custody of that uranium that needs to be put in place over that period into the future. So I think the only thing that really is going to change the supply dynamic is what the unit trust shareholders of these ETFs and these physical holding companies, what these guys as shareholders want in terms of return. Now, if you look at the price of what they've achieved, they started buying this stuff, let's call it circa 20. It's now 100. So notionally, the unit holders of these trusts have made 5 times their money. That's the leakage point for these physical holders is going to dictate the price in the short and medium term until such supply comes online. And that's the fundamental dynamics of the way I see it anyway.
Final word, Guy. You've been close to it, watching it, part of it for a long time, and have backed both the fund and your own view on where you think the market will go. What do you think the future looks like and where to from here?
Well, last year I got asked where spot could get to in 2024, and I said $175 a pound, and everyone laughed at me. And here we are on January 16th, and people are saying, "Oh, maybe that's not maybe that's conceivable after all." I think people are asking the wrong question as well, because I keep getting asked, what's going to push it above $100 now that we're here? What's going to keep it moving above $100? And it's the wrong question. The question is, what's going to stop it moving above $100?
Exactly.
And that's the real question. And the 3 rules of a nuclear fuel buyer who's managing the fuel load for a nuclear power plant. Rule number 1, don't run out of fuel. Rule number 2, don't run out of fuel. Rule number 3, refer back to rule number 1 and rule number 2. So, when it comes to that sort of equation, the price sort of becomes irrelevant. And again, we got tabled that at the Global Uranium Conference in November last year. Uranium was a $200 contract, not spot. If there was contracts being done at $200, what does that do for the generators? And the question that I wanted to ask back on that was, if uranium's contracting at $200, where's thermal coal and where's natural gas? Where are those prices? And also, how committed are governments to decarbonisation and energy security as well? So in the US, we've got a production floor of whatever it is, $15 a megawatt hour. There's production tax credits for whatever colour hydrogen comes out of uranium, out of nuclear. I can't remember the colour. If you produce hydrogen from a nuclear power plant, you'll get a tax credit. So there's plenty of things that you can give back to the utilities, or you put in a carbon price of coal and gas to accommodate that. So it sort of doesn't matter. To Richard's point before, like last cycle, financial hedge funds who are holding physical uranium at Port Hope, Confidant, Compurex, assuming they've filled out the 400 forms and police checks and government checks to do so, as we saw last cycle, you will see them dripping uranium in as it hits the price that they think it's going to get to. But what are we talking? We're talking 100, 200, 300,000 pounds. We're not talking the 30-odd million pounds we need a year to satisfy it. And with respect to SPUT, it keeps filing a shelf prospectus. So they've got another $1 billion in which they can go and use to. So if somebody comes and bids a premium, they just go and issue all those shares, buy more material, and of course it would continue to perpetuate. So, the only sort of risk you have with those structures, SPUT and perhaps Yellowcake, is if government steps in and tries to regulate that out or make it illegal. But that's a really long bow to draw on trying to restrict a physical ETF being a publicly listed securities exchange, especially somewhere like the US where they free markets and what have you. So it comes back to that simple equation again. At what point? And besides, if you believe the price reporters, the term contract's only at $68, so the utility shouldn't have a thing to worry about, surely. But of course, we all know that's backward looking, and that's going to re-rate the next few months. But I think everybody's made some really good points there. Once you've built a nuclear reactor and you've financed that over a 40-year life, and you're now getting 60 or 80 years out of that, and the whole nuclear fuel bundle is 15% of your costs, why wouldn't you keep it running? Especially when you're producing zero carbon or low carbon, if you want to get fancy, base load being 24-hour, 7-day-a-week electricity that the world's going to require. Otherwise, we're going to run on intermittency and rolling brownouts and blackouts.
On that note, we will close today's webinar. I do thank everyone for participating, Guy, for your insights, and to Richard, Keith and Rod for introducing what your respective companies are doing, but more importantly, sharing your insights and knowledge in relation to the wider market from a macro point of view. We have gone a little bit over, but we sort of took a view that it was a conversation worth having, and these conversations don't come along often enough. So a lot of interest in the conversation. So I thank each of you for your time and participating today. For everybody who joined in and watched the webinar, thanks for joining in, participating and firing through a whole pile of questions, a number of which I'll share with the presenters because there's still a few to go. As I said in the introduction, the purpose of this webinar series is to give you the opportunity to engage directly with companies that are on your watch list, or give you ideas for companies you may want to put on your watch list. Deal directly with the management, hear directly from them and ask questions. If there are any companies you want us to talk to or look at in the future, drop us a line. We'd love to get them on for you to hear more from. But to each of you who presented, thank you. Guy, thanks for your insights as always, and look forward to catching up with you all again soon. and have a great day.
Thank you. Thanks very much.